Precious metals staged a massive rally in 2024 and 2025 before peaking this past January. Since then, they've suffered a very sharp decline in prices. So what triggered the rally and the subsequent correction, and where might precious metals prices head next? The precious metals rally hinged on three major narratives. Number one, central banks might be losing their independence. Number two, central banks had been cutting interest rates despite above-target core inflation. And number three, budget deficits. It's no coincidence that precious metals prices peaked on January 23rd. That was the day that the news of Kevin Warsh's nomination as head of the Federal Reserve began circulating on Wall Street. Warsh had developed a reputation as an opponent of both quantitative easing and leaving short-term interest rates near zero. And he reinforced those credentials at his first meeting as Fed chair in mid-June, voting with the other members of the FOMC to remove the Fed's bias towards easing policy. When it comes to interest rates and inflation, there have been some changes there too, at least on the rate side. The ECB, the Reserve Bank of Australia, and Norges Bank recently joined the Bank of Japan in raising interest rates. Fed funds futures, meanwhile, suggest at least some likelihood that the Federal Reserve itself might tighten policy. Higher rates are typically bad news for precious metals. That said, core inflation in the US and around much of the world remains above target. But at least now central banks appear to be taking some steps to counteract it. The one portion of the bullish narrative for precious metals that hasn't changed at all is public finances. Countries as diverse as Brazil, China, France, Germany, Japan, the US, and the United Kingdom continue to run abnormally large budget deficits. If one factor reignites the precious metals rally, it might be concerns over expansionary fiscal policy.